The global cryptocurrency market has entered one of its most volatile and nerve-wracking phases in recent months. After months of steady growth and record-breaking highs in early 2025, investors are now facing a sudden and massive market downturn, one that has left many wondering if the bull run has finally come to an end. Bitcoin, Ethereum, and countless altcoins that soared to unprecedented levels just a few weeks ago are now bleeding red across the board. In this detailed analysis, we'll break down the real reasons behind the massive crypto crash, explore whether this marks the end of the bull cycle, and uncover what could happen next for digital assets in 2025 and beyond. 1. The calm before the storm. The year 2025 began with incredible optimism. Bitcoin broke above 90,000, Ethereum crossed 5,000, and many altcoins delivered life-changing returns. Institutional investors, retail traders, and even governments were talking about crypto adoption like never before. Major corporations were integrating blockchain technology, and the global market cap of cryptocurrencies briefly exceeded $4 trillion. The sentiment was euphoric. People were calling for Bitcoin to hit 150,000 and Ethereum to surpass 10,000. But as history has shown, extreme euphoria in crypto is often followed by extreme fear. 2. The first signs of weakness. The first cracks began to appear when liquidity started drying up in major exchanges. Trading volumes fell slightly, whale wallets started moving large amounts of Bitcoin to exchanges, and a few top influencers quietly exited the market. Retail investors ignored these warning signs, believing any dip was just another buying opportunity. However, these early movements were signals of institutional profit taking. The smart money was slowly exiting while retail FOMO, fear of missing out, remained strong. Then came the interest rate shock. Global central banks, led by the U.S. Federal Reserve, signaled another round of rate hikes to combat inflation that was still sticky across major economies. This announcement hit the crypto market like a sledgehammer because higher interest rates reduced the flow of cheap money into risk assets, and crypto is one of the riskiest of them all. 3. Bitcoin's breakdown. Bitcoin, which had been holding strong above 85,000, suddenly lost momentum. Technical analysts had been warning about a potential double top formation on the weekly chart, and once Bitcoin broke below the key support at 80,000, panic selling kicked in. Within days, Bitcoin fell to 68,000, triggering billions in leveraged liquidations. The entire crypto market followed suit. Altcoins, which typically amplify Bitcoin's movements, dropped 47% in just a few weeks. Mass liquidations on platforms like Binance, Bybit, and OKX wiped out over 10 billion in long positions, reminding traders that leverage is a double-edged sword. The so-called liquidation cascade spread like wildfire, and fear dominated sentiment across social media. 4. Macroeconomic pressure. Beyond crypto-specific factors, the global economy is under immense pressure. Inflation, although improving, remains persistent in key economies like the United States and Europe. Energy prices have been volatile, and geopolitical tensions, particularly in Eastern Europe and parts of the Middle East, have reignited concerns about global stability. These macroeconomic issues matter greatly for crypto because institutional investors treat Bitcoin and other digital assets as risk-on assets, similar to tech stocks. When risk sentiment declines, they sell off these assets to protect their portfolios. The recent decline in the Nasdaq and S&P 500 further confirmed the correlation. When traditional markets fall, crypto almost always follows. 5. The regulation shock. Another major factor in the current crash is the wave of regulatory crackdowns. In the U.S., the Securities and Exchange Commission (SEC) has intensified its scrutiny of major exchanges and DeFi platforms, targeting tokens that may be classified as unregistered securities. In Europe, new MiCA regulations have tightened KYC and AML requirements, while several Asian nations have limited crypto trading or imposed strict taxation rules. This has created uncertainty and fear among investors. Many worry that heavy-handed regulation will slow innovation and scare off institutional capital. When uncertainty dominates, markets tend to overreact, and that's exactly what's happening right now. 6. Altcoin bloodbath. If Bitcoin sneezes, altcoins catch pneumonia, and this time, they caught a full-blown fever. Coins that had rallied 300% to 800% during the bull run like Solana, Avalanche, and Polygon have seen steep corrections of 50-70%. Meme coins, which had exploded in popularity thanks to social media hype, were hit even harder. Dogecoin, Shiba Inu, and PEPE lost massive market caps almost overnight. This is typical during every crypto downscale. Retail investors chase the hottest narrative without understanding the fundamentals, and when the tide goes out, those with weak hands or speculative bets are the first to get washed away. 7. Whales and market manipulation. Another major contributor to the crash is whale activity. Blockchain analytics reveal that large Bitcoin and Ethereum holders, often institutional players or early adopters, have been transferring huge amounts of crypto to centralized exchanges. This usually signals preparation for selling. Moreover, certain hedge funds and trading firms are accused of shorting the market to trigger liquidations and buy back at lower prices. This kind of market manipulation, while unethical, is not new to crypto. Whales use leverage and coordinated selling to shake out retail investors before accumulating again, a tactic known as shakeout or washout. 8. The end of the bull run or just a correction? Now comes the million-dollar question: is the bull run over, or is this just a healthy correction? Historically, crypto bull runs don't end overnight. They usually go through multiple mini-crashes before a final blow-off top. For example, during the 2017 and 2021 cycles, Bitcoin experienced several 30% pullbacks before ultimately reaching its peak. However, this time feels slightly different. The market had already been overheating for months, valuations were sky high, and speculative mania had returned. This crash may indeed signal the late phase of the bull cycle, but it doesn't necessarily mean the long-term bear market is here. Some analysts believe the market is simply resetting before another leg up, especially if Bitcoin can stabilize above 60,000 and macroeconomic conditions improve. Others argue that the bull run is effectively over and that we are entering an 18-24-month accumulation phase, similar to post-2021. 9. The role of stablecoins and liquidity. An often overlooked factor is the health of stablecoins like USDT, USDC, and TUSD. Recently, there have been concerns about stablecoin reserves and liquidity mismatches. Whenever stablecoins face trust issues, investors rush to withdraw or sell crypto, fearing systemic risk. Stablecoin outflows from exchanges have reached record highs in 2025, signaling that large investors are moving funds to safer assets or back into FIRE. Reduced liquidity means lower buying power, which intensifies volatility and makes recovery slower. 10. Social media and panic psychology. Crypto has always been driven by sentiment, and in today's world, sentiment spreads faster than ever. Fear, uncertainty, and doubt dominate platforms like X, Twitter, Reddit, and Telegram. Influencers who were once shouting "buy the dip" are now silent or bearish. When retail investors see constant red candles and negative headlines, panic selling becomes contagious. Emotional trading often amplifies price drops, creating a feedback loop of fear and liquidation. The crypto market thrives on psychology, and right now, fear is the strongest emotion in the room. 11. Lessons from past cycles. To understand where we might be heading, we must look back. Every major crypto bull run in history, 2013, 2017, 2021, ended with a euphoric peak followed by a sharp crash. Then came a long accumulation phase where prices stabilized, innovation continued quietly, and weak hands were flushed out. Each bear phase gave birth to new narratives. The 2018 bear market birthed DeFi. The 2020 accumulation led to enthusiast and metaverse projects. The 2024-2023 recovery set the stage for AI and OWA real-world assets tokens. So while this crash is painful, it's also part of the natural cycle of crypto evolution. It clears out scams, overhyped projects, and bad actors, paving the way for the next wave of innovation. 12. Could institutional adoption save the market? There's a silver lining. Despite the crash, institutional adoption is still growing. Several large financial institutions, including BlackRock and Fidelity, have doubled down on blockchain infrastructure, tokenized assets, and ETF products. The recent approval of multiple Bitcoin and Ethereum ETFs, though followed by sell the news reactions, signifies that crypto is now recognized by traditional finance as a legitimate asset class. Once macroeconomic conditions stabilize and liquidity returns, these institutions could re-enter the market with massive capital inflows, triggering the next bull run. 13. The halving effect and future outlook. Another key event that will shape the future is the Bitcoin halving, which reduces mining rewards and historically triggers bullish cycles. After every halving, 2012, 2016, 2020, Bitcoin experienced explosive growth within the next 12-18 months. The next halving is expected to reduce supply drastically at a time when institutional demand may begin to recover. If history repeats itself, the current crash could be the final shakeout before the next major rally. 14. How investors should react. The most important rule in crypto: don't panic. Market crashes are painful but temporary. Smart investors use this period to rebalance their portfolios, focus on fundamentally strong projects, and accumulate during fear rather than greed. Diversification is crucial. Holding only speculative altcoins can destroy a portfolio. Allocating into Bitcoin, Ethereum, and select utility-driven tokens provides better long-term stability. Those who understand the cycles know that every bear phase is an opportunity disguised as disaster. 15. Conclusion: is the bull run over? The crypto market's huge crash in 2025 is a result of multiple intertwined factors: macroeconomic tightening, profit-taking by whales, regulatory uncertainty, over-leveraged traders, and widespread panic. Whether this marks the end of the bull run or just a deep correction depends on how the next few months unfold. If Bitcoin can hold key support zones around 55,000 and institutional confidence returns, a recovery could begin sooner than expected. But if global markets continue to struggle and investor sentiment remains weak, we may see a prolonged consolidation phase. Either way, one thing is certain: crypto isn't dead. It has survived countless crashes, FUD campaigns, and government crackdowns. The technology behind it continues to evolve, and the next generation of innovations will emerge stronger from this downturn. So, while the bull run might be taking a break, the long-term story of cryptocurrency is far from over. Remember, markets move in cycles, and after every crash comes a new wave of opportunity for those who stay patient, informed, and disciplined.